Welcome to Odisal Associates Accounting and Finance Tutors. We are in a series discussing common accounting mistakes small businesses make. These mistakes lead to their businesses not performing the way they should perform. Sometimes it leads to the collapse of the business. We have started with inaccurate financial records. That's one of the mistakes they make by not keeping accurate financial records. We identified 9 different accounting mistakes when we started, and we spoke on one. Today, I'm going to take another one, which is the second one in line that I mentioned that day. And I'm going to talk about mixing personal and business finances. This is one of the mistakes small business owners make. It affects their business negatively. Failing to separate personal and business finances, leading to confusion, errors, and potential tax issues. There is an accounting concept that deals with that. It is called separate business entity concept, which says that the business is different from the owner because the owner of the business or the owners of the business have different entity from the business. The business is having its own entity, can sue and be sued. Therefore, it is different from the owner of the business. What it means is that the business has assets, has liabilities, and has equity. Just like the owner of the business also have his own personal assets and his own personal liabilities. What we are saying that these assets and liabilities must be separated to assign the one that relates to the business and the one that relates to the owner of the business to the owner of the business, so that there will be no confusion and there will be no mix up. When you put together business finance and personal finance, you create a confusion such that you will not know how your business is growing. In the last episode, I gave an instance of a woman who was adding the profits he made from other goods that she was selling to the profits that she was making from another plan that she had, which at the end of the day confused her and she couldn't determine whether she was making profit or whether she was making a loss. So it's important, if our business must thrive and be strong, if we must be able to determine that we are making profit or we are making loss, we must separate our personal business, personal finances from the business finances. I'm going to highlight some effects of mixing personal and business finances in a small business. One problem you face is poor financial management. Small business often rely on simple records. The owners of those business may not have all it takes to hire professionals, so they rely on simple records. So when personal and business funds are mixed, it becomes very difficult and hard to track income and expenses accurately. This makes it difficult to know whether the business is making a profit or loss, because you sold 50,000 naira from the business and you got 30,000 from somewhere and you added it up, you have 80,000, and you think that all of them are income or revenue from the business. Then you match your expenses against that 80,000. Whatever profit you are calculating is higher by 30,000. Or in a business you are in your own business, you keep on taking money out of the business. When you are making your account, you rely on the value that you sold, not knowing that you have removed money or goods from the business. You under declare your profit. So it gives you a poor financial management because you will not be able to know what is coming from the business and what is coming from other sources of your income. In a business, any amount of money that is brought in by the owner of the business is called capital, and it has a claim on the assets of the business, even though it has a last claim, but it has a claim. What it means is that the business took capital from the owner to run for it to be operational. And then we also have the liability of the business, which is coming from outside source. It also has a claim on the assets of the business. That is why for every business, liabilities and equity have a claim on the asset of the business. So it has to be regarded as business capital and business liabilities. So every owner of the business, whenever he introduces money into the business, must be acknowledged and recorded as capital. When he withdraws money from the business, must be recorded and acknowledged as drawing in order not to confuse profit or loss. This is not used to determine the profit of the business, nor used to determine the loss of the business. Another problem that will occur is cash flow management. Taking money out of the business account for personal use can cause cash shortages. This may result in unpaid suppliers, inability to restock goods, or late payment of bills. So when the owner of the business keep on pinching from the business, collecting money, after all, it's my own business, he will not be able to manage his cash flow. Remember that he has debts to pay his suppliers, or let's say he has creditors to pay his suppliers, and he has to restock goods, or if he's a manufacturing company, he has to restock inventories for production, and he has to pay workers and so on. So, but when he continues to collect money from the business without minding that this money belongs to the business, not his own money, it will distort the cash flow of the business. So strictly, a business owner must check himself so that he will not be collecting money from the business as if it is his personal money. It is the business money. It is not his money. Inaccurate record keeping. Now, when you mix your finance, your personal finance and the business finance, you will not be able to keep accurate record because you collect money today, somebody comes to ask for 1 naira, you give. You want to buy something, you take money from there. Most of the times, you may not have time to record them, and you often forget that you collected money from the business. So there must be a high level of discipline for every business owner so that you regard business assets as business assets and not personal assets, and not touch them at all. If you must touch them, you must record them that you have taken them so that you will separate them from the business operations. You have difficulty in budgeting and planning. One of the important things about business is budgeting and planning. If you are mixing your personal finance with the business finance, it will be difficult for you to plan. It is difficult for you to budget because the money you have for the business is mixed with your personal money. So you might budget based on that, and at the end, it will not give you the right cash flow. And sometimes the money that you get from elsewhere may not always be there because it could be one-off thing. It could be even a relative that gave you that money. and you added into the business without taking cognizance of the fact that is not what is flowing from the business. When you do budget based on that, say I made a 50,000 naira, 100,000 naira last month. Meanwhile, out of that 100,000 naira, 30,000 or 20,000 was given by a friend or by a relative. When you make budget based on the 100,000 naira, you see that your budget will be short of that 30 or 20,000 naira that your relative gave you, because it's not every month that they will give you such money. So you must not mix your business finance with your personal finance in order to aid you in budgeting and planning. Tax complications. When personal and business expenses are not separated, filing tax becomes confusing. The owner may otherwise overstate or understate deductions, which can attract penalties or audits from tax authorities. It's also another problem. Now, with the new tax law taking effect next year, be sure that you separate your personal finances from your business finances so that the tax authority will not say that all that came to you came from the business. When you borrow money, it must be designated as borrowed. If it is borrowed for the business, it must be recorded as borrowed for the business. If you borrow it to pay house rent, you borrow it to pay school fees, you borrow it for anything, it must be indicated so that there will be no complication in tax payment. It will also lead to lack of business credibility. If you are dealing with suppliers, lenders, or investors who know that you are very unprofessional about the business finances, you will not want to support your business either by lending money or investing in your business. Even a supplier may not want to pay you because he will say, if he did not get money from his brother, he will not pay me. If he did not get money from his sister, he will not pay me. Therefore, I'm not going to supply to him or to her or to the business. So it makes you not to have or to lose credibility. It can also lead to legal risks and issues, especially when the small business is registered either as an enterprise or a limited liability company. Mixing finances can make it difficult to prove that the business is a separate legal entity. The owner may become personally liable for business debts. So that's the issue. If it's a registered business and then you are not separating your personal money from the business money, you might have the legal risk that we're talking about here. I remember a company that I went to prepare the account, a small business. And when I prepared the account, I saw a lot of money that came through the company that do not belong to the company. When we prepared it and sent the audited account to the revenue, it was a very tough war to convince the revenue that those money that came into that business account are not the business money. We have to finally negotiate and reach agreement because the revenue refused. So if you mix up your money with the business money, you stand at a very high risk. Difficulty measuring business growth. Of course, from all the examples I've given, you see that it will be difficult for you to measure the growth of your business, because when you bring money that was given to you by your brother, by your sister, or even the money that you are keeping as a treasurer or a cooperative society savings, you keep them together. How would you know which one is your money and which one is not your money? And you will see that all these things may not have the correct record that is needed to separate them. So ab initio, you have to separate them so that they will not be in the same place. It will be different from each other. And it will lead to stress and confusion. The reason why most small businesses they don't prepare the account is because by the time you look at the account and you see a lot of things that do not belong to the business inside the account, you get tired. You look at it and you throw it aside. Since I'm making a profit, I'm not making loss. My business is moving. Let me not bother myself. Because you see the records are very confusing. So you don't want to stress yourself. You just leave it. So as it is, the business remains what it is. You cannot say how much you derived from the business, what gain you made from the business, because all the while you have been using both your personal money and the business money, putting them together. So your profit is not profit, your loss is not loss, because it's mixed with personal finance. Constantly juggling personal and business expenses from one account can lead to confusion, stress, and poor decision making. Now let's look at solution to mixing personal and business finance. The first one that we are going to look at is you have to open a separate business bank account, which will be different from your own personal bank account. If your business is registered, use the business name to open an account. And then don't think that because you have opened an account in the name of the business, that every transaction that comes, even your own money, you throw it into that account. Open your own personal account. Open your own personal account. And every personal money should be thrown into that personal account, while business money should be banked in the business account. The account has to be separate. The one for the business will bear the business name. Your own will bear your own name. So every personal money goes to your own bank account, while every business money goes to the business account. It will create a clear line between personal and business transaction. Second, pay yourself a salary or allowance. Instead of taking money from the business whenever needed, the owner should set a fixed amount as personal income. This makes it easier to track withdrawal. Pay yourself a salary or allowance. Instead of taking money from the business whenever needed, the owner should set a fixed amount as personal income. This makes it easier to track withdrawals and maintain stable business finances. So assign yourself how much that you take every month, so that at the end of the month you pay yourself, you call it salary, and you remove it from the business account and put it in your own account, so that all your personal expenditure will come from there. If you are also giving money to the business, you designate it as capital, introduction of new capital, so that there will be no confusion. Another solution is keep proper financial records. Since you are going to get your own personal money, you must make sure that you keep accurate record of the business finances. The transactions and operations of the business must be well recorded, so that you will not make mistake. Another suggestion is use accounting software or mobile apps. There are some small business software that is affordable, or that you can even see free online. You can go online and then record them. Another one is you create a business budget. It's important for us to have a budget for our business. The budget gives you a clear roadmap where what you are following, what you want to do, and how you want to do it, how much you want to spend, how much you will get from all your business. So it's important. Every small business must develop the skill of budgeting. You must budget, do your budgeting very well, so that you know what you are going to spend and what you are going to get. How much you spend, how much you get is important. Use business funds strictly for business purposes. You must make sure that whatever you are taking from the business is for business purpose. If you do that, you ensure that you pay yourself salary, so that you'll be able to use your own money and not the business money. Every business money must be used for business. Don't use it for another thing. Keep your receipts and supporting documents. When you go to market, you buy things, don't throw away receipts. Insist that you get receipt for whatever thing you buy. It will be easier for you to do accounting. Even if you call somebody to come and prepare your account and your receipts are there, it will be easy. So ensure that every time you go to buy something from the market, that the receipts are there. File them in a clean place. If you have an accountant, give it to the accountant to record. If you don't have, file it in a file, keep them in a file neatly. No single receipt should miss. And you should not buy anything without receipt. You must demand or request for receipt whenever you buy something. And you should also create a means of giving receipt when you receive cash, and also invoices, especially when goods are bought on credit. You have to have these records and these documents. These are called supporting documents. You can also hire a consultant or an accountant. A consultant that will be coming periodically to prepare, to keep your record, or an accountant that is employed by you to handle your business. If you are not able to handle your business yourself, you hire an accountant or a consultant. Any of these can help guide you in record keeping, so that the business finance will be separated from your personal finance. You should also track all your contributions and all your withdrawals. If you must spend from the business, you must record them clearly, that this is your personal expenditure that you made from the business, so that in preparing the account, this one will be regarded as drawing and will not be used to calculate profit or loss. And if you are bringing in money into the business, contributing money to the business, you must clearly record them, that these are monies that you brought into the business, that is not as a result of sales from your daily activities, but money that you took from elsewhere and bring into the business. The record must be clearly stated. This will increase your owner's equity or contribution to the business. And if you take out money, that is called drawing, it will reduce your contribution into the business. So you must keep a clear record of whatever amount you are introducing to the business. Let's assume you started a business with 100,000. Now, the next day, somebody gave you 20,000 and you went to the market and used that 20,000 to buy goods for your business. Record it as contribution into the business. It will form part of your capital or equity, as the case may be. If you are doing contribution somewhere and it was your turn and you got 100,000, you added into the business, record it again as introduction of capital or contribution into the business. This must be clearly recorded, so that you will not use it to calculate your profit or your loss. The last one I will give you here is to educate yourself on basic financial management. You should also find time, read, go to YouTube, go to Google, read voraciously. Get an accountant that can teach you, so that you understand, at least you have a knowledge about financial management, so that you also understand that the business is different from the owner of the business, and you'll be able to handle your business. What I normally tell people is, even if you are going to hire somebody that will work for you, have a little idea of what that person wants to do for you. Because when you are negotiating, even if you are talking about price or you are giving somebody task to do, you should be able to know what is involved in that task. You should be able to know the level of work that is involved and the things that are involved before you're able to negotiate properly. So it's important that you educate yourself in every line of business that you want to do. Finance education is very, very important. Even the big companies teach their managers finance for managers, for non-accounting managers, because they know that everybody in the business handles or deals with things that involve money. Therefore, it is needed for you to educate yourself on basic financial management. In summary, for small businesses, mixing personal and business finances leads to poor financial control, tax issues, lack of credibility, and confusion about the true performance of the business. To succeed, small business owners should maintain separate bank accounts, keep proper records, and pay themselves a regular salary instead of taking money at will. It's important for us to note this so that we'll be able to account for our business properly and grow our business. Nobody invests in a business and expect to lose or the business to come down. All of us want our business to grow. So if you are able to do this, you'll be able to maintain and the growth of your business. This is where we are going to stop in this episode. We'll continue because we have identified 9. I have just done 2 now. The third one will come to you later. So keep on following us, keep on subscribing, keep on sharing our video, discuss with your friends so that they can also go in and check. You will benefit. Thank you very much.